In our last corporate video, we dealt with how corporations file and pay taxes. Unlike employees, there is no corporate withholding tax that permits corporations to pay their taxes throughout the year. Instead, like a self-employed individual, a corporation must make estimated tax payments. Let's cover those in video T11C, which starts now. I'm not sure how, but I've managed to make the video on paying corporate taxes longer than the video on calculating corporate taxes. Anyway, as we have already seen, corporations file Form 1120. Although for years this tax return was due on the 15th day of the third month after year end, which would be March 15 for a calendar year incorporation. A few years back, this was changed to the 15th day of the fourth month, which would be April 15th for a calendar year end corporation. As I mentioned in the intro, corporations must make estimated payments. The due dates are not the same as those for individuals, and neither are the rules to escape penalty. Estimated payments are due on the 15th of the 4th, 6th, 9th, and 12th months of the tax year. Thus, a calendar year-end corp would have payments due on April, June, September, and December 15th. Note that the final payment is due before year-end, and thus the corporation may not know its exact tax liability. In order to provide some relief for the requirement to pay 100% of this year's tax, the tax rules permit a safe harbor for tax payments to avoid penalties, and the rules differ on this safe harbor as to whether you are a large or a small corporation. Small corporations have it kind of easy. As long as they pay 100% of the prior year's tax, they can avoid penalty. Any additional tax due can be paid no later than the initial filing deadline of the 15th day of the fourth month. And you have to pay your taxes whether or not you extend your tax return. For large corporations, they have to pay 100% of this year's tax, or they can use an annualization estimate method to calculate the tax payment amounts. And this method is beyond the scope of this course. As we've learned over and over, corporations are double taxed. But to be explicit, the double taxation works as follows. A corporation computes its taxable income and is required to pay corporate tax. It can then distribute its post-tax earnings to shareholders as dividends. But dividends are not deductible by the corporation. The dividends are then taxable as income to the shareholders. This can be contrasted with raising capital by means of debt instead of equity. Interest payments to bondholders are deductible. This creates a playing field that is tilted in favor of debt over equity. Let's look at some examples of the effects of double taxation. We'll start with a corporation in 2017 with the old tax rates. At income of $400,000, the corporate tax rate is 34%, leaving after-tax earnings of $264,000. These earnings are then distributed to the shareholders who pay a 15% dividend tax, leaving just over $224,000, for a combined rate of about 44%. The new 2018 corporate tax rates lower the corporate tax, and thus the shareholder now suffers a combined tax rate of about 32%. If this were a pass-through entity, the combined tax rate would be only about 23%, including the effects of the QBI deduction that we discussed a few videos ago. So lower corporate tax rates definitely reduce, but do not eliminate the effects of double taxation. Okay, so we spent a lot of time talking about the disadvantages of corporations from a tax perspective. But before we close out this discussion, we should raise the issue of tax burden. Get into the Wayback Machine and recall that the payer of the tax is not always the bearer of the tax. When it comes to corporations, who bears the burden of the tax? This is a fairly difficult economic puzzle to solve, and as you might guess, the answer is, it depends. If the corporation is unable to pass the tax cost on to customers, just as it might or might not be able to pass on the cost of some other raw material, then corporate profits will suffer, and maybe the shareholders ultimately bear the burden through lower dividends. If the cost is easily passed on to customers, then the tax is actually borne by customers, and in some instances, The prices have to remain fixed, but the shareholders can squeeze either more productivity or lower wages, making the employees bear the burden. Each corporation would need to be analyzed, but what we know for sure is that corporations themselves do not bear the burden, because even though they are not characterized as a pass-through, they really are just a conduit for earnings to their owners. That seems like a really great note to end this video on. If the idea of the corporate tax burden appeals to you, recall back in Module 1, I listed some really great books on tax policy. Many of these try and tackle this issue in a meaningful way that is not totally biased by political inclinations. We're going to ping pong back into pass-through entities in Chapter 12, and so for now, thanks for watching.